Good morning, everybody, and welcome to the Daily Energy Markets podcast. It's 10:30 UAE time, and Brent crude oil is trading at 84.45, up about a little over 0.5% in early morning trade in Asia. All things considered, a fairly tepid week. Dr. Carol Knackley, CEO of Crystal Energy, a week when there's clearly been a breakdown in the biggest political story of the region, Israel's assault on Gaza, now going into Rafah. The worst case scenario has transpired, but the oil markets seem unconcerned. Your thoughts on the intersection between those two things?
Good morning, Sean. Good morning, everyone. I don't agree that the worst case scenario has happened. Definitely what is happening in Palestine and Gaza is outrageous, but still not the worst case scenario, because the worst case scenario, in my opinion, is if the conflict really spreads across the Middle East and we see more than this kind of game exchange between Iran and Israel getting more serious. So yes, it is very sad what is happening in Gaza and the attacks on Rafah, but I don't think this is a worst case scenario. In that respect, this explains partly why oil markets are where they are today. But remember, Sean, we don't look only at one incident in isolation. First of all, there have not been any supply disruptions. There is still an ongoing war in Ukraine, right? But still, all this has been captured, if you want, or absorbed by the market. No supply disruptions. There are supply cuts from OPEC Plus, and we have to wait and see what they will do at their next meeting. But there's plenty for non-OPEC supply. Demand, yes, we are seeing growth, but not this kind of massive growth in demand, and especially from China, some positive data. But when you dig deeper, you see structural problems. So on balance, the market fundamentals are reflecting realities in the market, and add to that plentiful spare capacity that dampen the geopolitical risk premium. So all these on balance, I can understand why prices are where they are. Interestingly, Sean, not long time ago when I was with you on the show, I think it was last month, people were already talking about $90 a barrel being the floor, the new floor for prices, and they were proven wrong, because market fundamentals are not strong enough to justify yet. They are strengthening, but on their own, they don't justify higher prices.
James McCallum, CEO and Chairman of Exergy Group, Professor of Energy, Strathclyde University, currently in Scotland. James, the oil price obviously started the year at $75-76 a barrel. It's clear to say that we've seen the low of the year.
Look, I mean, the consensus is that amongst the experts, with perhaps exception of Omar, that we'll see oil prices soften through the remainder of the year, but nobody is calling that kind of a price level softening. I think probably we have seen the low of the year behind us. It remains to be seen whether or not Omar will be right, and we'll actually see this point in the market as a floor, and things will kick on from this point. So no, I mean, I tend to share the view that we're going to continue to trade in this very, very sort of stable range until something else happens. Carol's points around the market are absolutely valid, and as long as we don't see something like a regional expansion of what's actually going on in Gaza, the markets are just rolling with it right now, and there's nothing out there ahead of us other than one of your famous black swan events, Sean, that I think takes us out of this current range.
Amina Bakker, Senior Research Analyst at Energy Intelligence. Picking up on James' point there, what's the something else that's going to happen, Amina? You were quite cryptic in your posting on Twitter or X the last few days, that pay attention, that June 1st isn't the day in which OPEC Plus has to decide on its cuts, because the big cuts are unilateral and Saudi Arabia might choose to do them at a different time. As you sat on the stage with the Saudi oil minister very recently, did he slip that piece of information to you? What's the latest in that message you're giving the market?
No, it's not cryptic at all, Sean. It's quite obvious. I mean, we all know, it's public knowledge that the cuts that we're talking about that could possibly be unwound or under the current agreement expire by the second half of the second quarter. These are voluntary cuts. These are cuts imposed by 8 members of OPEC Plus. This is not a production cut imposed by the entire group. Therefore, those cuts or anything related to those cuts is just a phone call away within, and the decision needs to be made within those members. They don't have to go to Vienna on June 1st and decide. They could either make the decision about it before or after. It doesn't have to be on June 1st, because I feel like
obviously it doesn't have to be. I mean, it could be tonight, but the point is that usually these things happen in synchronization. A meeting of this scale, not to proceed with that announcement would be quite, it could be that event that James just referred to. If they all went to Vienna and there was no mention of those cuts that Saudi Arabia and others are shepherding, that could be quite a significant market event.
No, I feel like traders are assuming too much, Sean, not understanding that, I mean, this decision doesn't necessarily have, this is not the deadline for them to make that decision on June 1st. They need to realize that. So if they go into the meeting, I mean, it's still unclear if the meeting so far, they say it's in Vienna, maybe it's going to be a virtual meeting. So if they don't end up making that decision and make the decision, for example, on June 2nd or 3rd or 4th or 5th, I mean, they can decide to do that. It's not the cutoff date. There is a kind of impression that traders are trying to suppress prices until that decision is made. So that's the kind of, idea that's floating around, and just putting it out there that the decision doesn't necessarily have to happen on the day of the OPEC meeting, because it doesn't concern all the members. For the time being, Sean, everybody thinks that everyone in the market is baking in the fact that they will be extending these cuts further. There's a need to extend to the cuts, because I agree with Dr. Carroll that there are uncertainties around where demand is going. We're seeing prices still very shaky, so they might need to extend those cuts further. Let's see what they do in the end.
Dr. Carroll, your thoughts on that? I mean, ultimately, we're nearly, getting close to midway through the year. Oil prices solidly in the 80s. You would think OPEC Plus is, pretty happy, not doing it. They wouldn't do anything to rock the boat. Your thoughts on the decision that they face?
2 things to highlight here. Actually, if you plot the prices since 2022, for instance, or you can go a little bit earlier, but over the last few years, 3 years, you can see that actually since 2023 till today, despite this kind of prices going up versus going down, these daily movements, we have had a very well-defined range or corridor, that I would like to say, and prices have been relatively stable compared to previous periods. So in that respect, I would say that OPEC and its allies and OPEC Plus have kind of achieved their mission of stabilizing the market, and prices in the 80s are not really low and for many members. That said, it comes with a big caveat. We're talking about nominal prices. When you take, and we are in a period of inflation, you take that out, when you compare real prices, then you can see that prices are actually well below what many of these OPEC members would like to see to achieve budget balance or other economic targets. So there is a desire, of course, among some members within OPEC Plus to maintain prices above a certain level. Of course, if you look at the forecast or the expectations of OPEC through its monthly oil market reports, you could see that they were the most bullish in terms of demand expectations. But I have to say they are not the only one for oil demand. Even on the macroeconomic outlook, or on what Federal Reserve would do or other central banks would do, many expected already interest rates to be cut starting, let's say, from maybe earlier this year or a month ago, but that did not happen. So there's a big unknown, that is demand outlook, and that by itself is a challenge to OPEC on bullish sentiment regarding the rest of the year, because they were expecting a market in deficit for the remainder from the second half of the year, and I don't think we have a market in deficit. We don't.
When you say in deficit, you mean
Let's say less supply than demand. The demand is exceeding supply. Yeah, so I was trying to correct myself because I don't like to use this terminology anyway. So in that respect, if I put all these together, I don't see there is a rationale for OPEC members to change course and then start cutting. I haven't seen sufficient evidence for them to change their decision, because whatever decision they based, whatever conditions they based their decision on, have not changed significantly to trigger a change in that strategy that they have adopted.
James, I wanted to get your insights on, we've been through the sort of first quarter earnings results from all the oil majors and all the oil services companies, because obviously a big factor there on the supply side, while OPEC Plus is curtailing and keeping the market as tight as they can. We always have the potential, as we've had in previous years, that the particularly shale oil producers could come to spoil the party. Is there anything you saw in the results from the majors or from the service companies that would tell you that we could be getting more supply from the US in the second half, that they could invest more money into the ground?
Yeah, it's a great question, Sean. I think there's the word I would probably use is there's a sort of incremental type of an indication that perhaps the boardroom discussion is changing, and there are several aspects to that. You've got the European super majors versus the US super majors share price differential, and how does one close the gap on that? What would one do to do that? We have the access to capital from the banking sector to get after new capex investment. Is that coming back towards the oil and gas industry? Is it still staying away? To pursue, if you like, the sustainability agenda, which the banks led on, and which had such a massive impact on the major super major oil and gas companies. Look, there's a little bit of a report on the press digest around sort of Halliburton's results coming on the back of Schlumberger's results being ahead of expectations, but it's incrementally ahead. The reality is there's a couple of things in there which are confirmatory to some of the points that I've been making through the year. North American revenues for the service companies are down, on where they were a year ago. That's really, really interesting, I guess, for most people. And coming back to your point about the US shale oil can come to the party and spoil the party. There's not new drilling going on in the shale basin. As I've said before, the activities around acquisition, buying your competitors, adding that production to your existing production. That's what Exxon has been doing. Shell, really interestingly, continuing the rhetoric of reversal away from their green agenda back towards a more traditional oil and gas agenda. BP still the super major that's in the doldrums around its share price position. So no, there's not an awful lot happening there. I think for me, I am picking up that capital is likely to become increasingly available from the banks, but dividend policy continues to rule with the super majors. It's keeping your shareholders, the ones you've got, on side, and it's not going into capex.
Amina, we've had some sort of mixed messages recently from the Biden administration about their management of the Strategic Petroleum Reserve. Some indications that they might use it if prices were to get too high, like they did 2 years ago ahead of the midterm elections, or the other reports that they might be buying to replenish it. The commentary from Amos Hochstein was that there's lots of, even though they might be buying, there's still lots of storage there that they could call upon if necessary. How do you think that would be reacted to by OPEC? Could that impact OPEC Plus decision and supply policy for the second half?
Obviously, OPEC Plus, Sean, doesn't like it when the U.S. announces SPR to manage the price. I mean, this SPR in the first place is there to use in case of an emergency or a huge outage in supply. We don't have that. That's not the case. So if they're going to be using it to suppress prices, then, I mean, we saw that policy. It's kind of a failed policy. It didn't really work to do that, and we're at a level now where U.S. stocks are at a 4-decade low. In theory, yes, yeah, they would need to replenish those supplies in order to release them at a later date. But even though, I mean, I think it was yesterday or earlier this week, they announced that they would buy at 79.99. That's the price. So they've kind of set a floor there for where they're comfortable buying. But the volumes we have so far are really small. It's 3 million barrels or 3.3 million barrels. So it's quite a small volume for May. Yeah, and to wrap it up, OPEC doesn't like it when the U.S. uses its stocks to impact prices. But it's an election year, so if these prices do get higher, we might get that kind of reaction from the U.S.
Carol, we had a news yesterday or overnight reported from Reuters that OPEC will stop publishing its calculation of the world's demand of its own crude, which they do on a monthly basis. You know, the call on OPEC this month is X. And now they're going to switch that to the call on OPEC Plus, which of course, this OPEC Plus has been around 6-7 years now. Your thoughts on that decision? What does it do? What does it not do?
I haven't really thought about it much, except that for me, it makes sense because when we're talking about OPEC, and I keep on referring to data from OPEC, but actually in my mind, I'm also thinking about what the Plus is doing with OPEC. And this is where many people get lost in translation because yet it's not as formalized as OPEC, but so far, you know, if you are with your partner in a European country for more than a few years, then that's it, you are officially, you know, married. So the same rules would apply to you, whether you are officially married or not. That is a long-term partnership or alliance or whatever you want to call it. So maybe legally they are not, but I think it makes sense from my perspective that they are expanding, if you want, that data, because we're not looking only at OPEC, we're always looking at OPEC Plus. But I would like to go back to two things, Sean, about the SPR and the US. Please. It's important to remember that the SPR have kind of lost the importance that they had, the Strategic Petroleum Reserve in the US, after the shale revolution. So the management of the SPR pre-shale is not the same as the management and the relevance of SPR post-shale. And yes, they have been going down, but they still remain significant. And if I'm not mistaken, among the largest or the largest in the IEA. The second thing about using the SPR, you know, today to depress prices, we should not take it in isolation from the inflationary pressure in the US. And they have come down significantly compared to what they used to be before. So that's why I don't think just if prices go to 90, the US is going to release SPR unless they have other significant macroeconomic reasons that would drive them to do so. So that's what I wanted to highlight about the US and its SPR. I think it takes more attention than it deserves, actually.
Let's go to the survey question this morning, which is touching on where I asked James earlier. Brent started the year at just above $75 a barrel. I think it was January 2nd or something like that. So it's fair to assume oil markets have already seen the low for 2024. Do you agree or disagree with that statement? James, I wanted to also get your thoughts on the growing sort of noise regarding BP, Shell, and Total moving their listing from Europe, their stock market listing from Europe to New York. It's sort of been one of those old chestnut stories, a bit like Carol said about SPR. You know, it sort of drumbles along. Sometimes it seems relevant, sometimes it's not. Your thoughts on the European oil majors sort of relinquishing themselves of what seems to be increasingly a burden of being listed on European markets?
Oh, that's an interesting use of the word burden, Sean. Look,
well, the burden seems to be that their share price is suppressed because they have a overexposure to transition.
Yeah, look, there's that. That's and the companies that you would look at, Total, BP, Shell. You know, clearly there has been a widening, if you like, of the gap. You know, if you take a look at, say, around about 2018-19, you know, the gap between the share price on the basis of the multiple and EBITDA, you would have seen a difference between, say, Shell and Exxon. Shell would have been trading around about 6 times EBITDA. Exxon would have been trading around about 7 times EBITDA. Look at it today, 2024. They're both down, interestingly, albeit that Shell's at a record share price just now, but they're both down on those multiples. Shell today trading at 4 times EBITDA, Exxon trading at 6. So the gap has widened between the US super majors and the European super majors. And clearly the talk in the boardroom is, how does one close that gap? I think Shell has been quite successful in making very positive moves in its share price by going through a cost-cutting exercise. I think BP is about to do the same. Both BP and Shell have reversed back from their commitments to the net zero conversation, and I have to say I find that unfortunate. Total have maintained their course, and Total is the latest of the companies that's investigating the potential. I'll be very disappointed if on a personal level, if the European super majors choose to move away from the European markets across the United States. I have long hoped that the oil and gas super majors would continue, or would the conversation around taking a thought leadership position on the whole of the energy sustainability agenda, not just simply the energy security piece. It doesn't seem that that's going to be the case. So the reality is that I think it's flashing up as a discussion. I honestly don't think it'll happen. And the principal reason for that, Sean, is it's worth remembering that to get onto the S&P 500, the company has to have the largest part of its resource base, its people, its headquarters, and everything in the United States. And whilst I think the European super majors would like to see the shale price cap close, I don't think they're ready yet to move all of their people across the United States.
Amina, I wanted to get your thoughts and insight on the article that you guys published yesterday, Energy Intelligence. It's not your story, Simon Martelli. I would imagine, though, that you have an insight on it, given your expertise. That basically the headline is "Touch Baseline Talks Loom for OPEC Plus." We're looking towards the end of the year when the baseline, the quotas, whether not the voluntary ones, but the quotas in which all countries operate, are up for consideration, and that this may be a more difficult conversation as that's not so far away now. And obviously you've published a story thinking obviously it's near enough to be of matter. Where do you think that conversation goes in the coming months?
Sure. Well, we published that story now because the 3 independent companies have been reaching out to all the states concerned and are currently revising or reviewing where their capacities are at. So that process is taking place now and should end by the end of June. Numbers should be submitted, but the group have until December to decide what the new baselines will be. And this will reflect better what capacities each country has, and you won't get a mismatch where some countries are not able to meet their quotas. We know that some countries have been increasing their capacity, like the UAE. Sean, that they've recently updated the capacity on their website, which is now 4.85 million barrels a day. Industry sources that we've spoken to so far are doubting that it's at that level. That remains to be seen, and remains what kind of evidence the UAE could show to the independent sources that they could actually reach that capacity, and it's sustainable capacity. But that conversation is always a tricky one. We've seen countries leave OPEC because of it. We had Angola last year. I mean, many countries, even though they can't reach a certain level of production, on paper, they would still want a capacity or a baseline that is higher than reality, that kind of guarantees them a certain share of the market. So usually when you talk about capacity review or baseline review at OPEC, it's kind of a can of worms, and that's why they try to avoid the subject for a long time. But I think now they really need to reassess, because we do have discrepancies between what countries are able to produce versus what's on paper.
Just to follow up on that, I mean, what's happening, as you referenced early in your early part of your comment there, was that Woodmac, Rystad, and S&P Global are doing a review of every country's current production capacity. That is a commissioned request from OPEC, as I understand it. Is that OPEC Plus or OPEC? OPEC Plus.
OPEC Plus.
OPEC Plus. And those reports from those three companies are due by the end of June. Will they be made public? Do you know?
It's not clear. I mean, we did get kind of indications last year when they did reviews for some of the African states. You do hear numbers coming up that wasn't officially announced or anything. I mean, the official announcement comes after an agreement is taken, and then OPEC or the Secretariat would publish those numbers.
Just again, in the first sentence of this article, which I encourage everybody to read, Energy Intelligence puts out there that there is some pressure within the group to start unraveling the 2.2 million barrels a day of voluntary measures by 8 member countries. I just wanted to understand from you what that means. There's some pressure within the group to start unraveling these cuts.
Some countries within the ones that offered the voluntary cuts would like to see more of their supply come into the market. I mean, we already saw that, for example, Iraq, there's some overproduction from Russia, some overproduction from Kazakhstan, and they've offered the compensation cuts as a kind of, you know, to stay aligned with their quota. So that's going on. But the more, I mean, cuts are not easy to maintain, Sean. So there is some pressure from some of these countries to start releasing additional supply to the market.
Carol, I wanted to get your thoughts on where we are with the speaking of cuts, the infamous Fed cuts that are not coming or not seem to be drifting further away, but then the last few days they've come back into view. Your thoughts on the outlook for that as we move forward into the second half of the year and its relevance for the oil markets?
It's interesting to see how the whole conversation shifted, whether, I mean, it applies for oil market, but also on the macroeconomic outlook and the monetary policy, particularly for the interest rate, how it shifted 180 degrees from the beginning of the year to where we are today. Because I do recall many get overexcited at the beginning of the year talking about cuts starting as soon as, you know, the second quarter of this year. And yet, fast forward 3-4 months later, you find even some analysts saying that actually there could be a room for increasing the rate. I'm not saying this is going to happen, but just like this kind of sentiment has shifted 180 degrees. But it is a well-known fact, Sean, that when it comes to taming inflation, just when you feel that you reach the end of the rainbow, then you realize that you're not there yet. So what they call it, the last mile being the most difficult. And this is what the central bank, the Federal Reserve of the US is conveying, that what they try to, while they were having, you know, positive data, encouraging data to maybe support change in course, then that data changed. But we have to wait for a longer period of time to see that data consistently sending the strong signals for the Fed to change its course. But at the moment, they are not talking about starting the cuts. They are talking about maintaining their course of action. And then if conditions change and they are convinced, then they may start cutting. But what we are definitely noticing is the divergence between European central banks and the Federal Reserve. So, and I'm saying European because I'm including the UK as well. Versus, for example, European Central Bank, the rhetoric is very different from that of the US, whereas before we could see all the time that they were talking about the same thing. Now we started seeing divergence, so it could be a question of time before we see similar action from the US Federal Reserve.
James, give you the last word this morning. Sun shining there in beautiful Scotland. The only thing that's shining. The morning after the night before, results in the UK elections, the local elections as they call them, it appeared the Conservatives got a big whacking. What does that point towards as we move towards the inevitable general election?
Yeah, look, I mean, we're like the United States, we're in for an incredible year of politics and electioneering, and we're beginning to see a lot of that. Unfortunately, what that means is an an awful lot of fence sitting from the political parties. I mean, you're certainly seeing that from Labour, unwilling to come out and put any clear line in the sand around, will they go ahead with a national energy company? Will they put out revised numbers in terms of their investment into renewables? Answer will be no, but then certainly at this particular point in time, we even had an issue, over the course of the last couple of weeks, where there was the possibility for the reintroduction of free movement of young people under the age of 30 between Europe and the UK, and it was just slid back across the table towards Europe. What was that? A mischievous move to try to sort of like see what Labour's position would be on that sort of immigration policy. If it was, it didn't really achieve anything. And Scotland, of course, in the course of last week has had its own movements with the change of the First Minister, and it'll be some weeks now before we actually see what the new First Minister's position is on the relationship which the Scottish National Party has with the Greens. So yeah, look, I mean, we are clearly in a year where everybody is predicting that significant change in the UK will happen. That change may roll over into Scotland. Maybe give the last word to Scotland. SNP predicting a massive swing out towards Labour up here as well. Yeah, it's going to be a very, very interesting year from the point of view of listening to the politics on the ground here. And to be honest, I'm looking forward to it.
Yeah, I'm sure. It certainly would be. I mean, amongst the interesting parts of the story is, the swing, as you mentioned, in Scotland, because without it, Labour can't really get the majority they need, it would appear.
That's correct.
And without that majority, then they just kind of stumble along. We're going to have to wrap it up there. As always, wonderful. This is the A team, one of the A teams. I would be unfair to say to the others, but there's another A team coming on Sunday, of course, with Christoph Ruhl and Mike Muller. But Amina Bakker, thank you so much as always. Carol Knackley, thank you. Excellent. James McCallum, wonderful to have you all on, giving us your insights on this Friday as we wind down the week. Clearly, oil markets in the happy spot, one would say, 84.45. Everybody at Goldilocks, I suppose, to overuse a phrase. Producers and consumers have to be relatively content with that. And headlines just passing that the British economy has actually come out of recession. So, these oil prices don't seem to be too damaging there. Thank you, guys. Have a great weekend. All the best.
Thank you.
Thank you,
Bye-bye.
John. Thank you all. Bye-bye.